CBOE's volatility expert sees a trend that points to more market weakness. Mandy Hsu is the firm's head of derivatives market intelligence. Mandy, great to have you with us on a day like today.
Thanks, Melissa. Great to be here.
Huge spike in the VIX. What is going on, in your view?
Yeah, so I would agree with what Tim was saying earlier, that there's definitely been a shift in the market over the past couple of weeks, where initially I would say investors across both equity and bond markets were treating tariffs purely as a supply-side shock, right? Looking at the inflationary impact of higher prices. Over the past 2 to 3 weeks, particularly in the bond market, we're starting to see that growth concern really come through in the form of lower yields, in the form of more Fed rate cuts being priced in. Now, what's interesting to me is right now, volatility, yes, is higher, but I think there's scope for it to go even higher because the way the options market is still pricing tariffs is as a stock-specific catalyst, not as a macro catalyst. So it's still trying to pick out the winners and losers of the tariff policy. But what the bond market is signaling is that we could be in for weaker growth, potentially recession, and that, as we know, is bad for all stocks.
So, Birch, thanks for being here.
Yeah.
So we see volatility tick up a lot. To me, it doesn't feel panicky yet. What is a number that starts to reflect to you panic?
Sure. I would say it doesn't feel panicky because investors have actually been hedging. So one of the things that we've been highlighting, I think last time I was on the show, we were highlighting that we were seeing elevated hedging activity all throughout the past couple of months going into this. So I think that partly is the reason why we haven't seen panic. What I would look for is correlation in the market, implied correlation. And we have an index, Core 1N, which goes hand in hand with the VIX. And when that index really starts spiking higher, that tells you that that the options market is pricing for a macro sell-off. That usually is when the panic sets in.
Where are we right now on that?
It's about 20, historical average 40, and periods of crisis can go up to 80 to 90. So we are well below average.
What was it, for instance, over the summer when we saw the VIX spike to 40 and we saw that major sell-off?
That was up above 40.
Oh, okay.
Yeah, for sure. Yeah.
Okay. Mandy, how about 3-day moves that we've had in the S&P? I mean, there's a lot of different stats out there, but you can make an argument the kind of volatility we've had over the last 3 days. Up 2%, down 2%, up 2%. We haven't seen this really since almost the market was trying to find a bottom in COVID.
Yeah.
And I just wonder whether this should tell us that the psychology of the market has changed. 3 days don't make a trend change, but the correlations you're talking about seem to me to be starting to take place on the index level.
Yeah, I think the higher levels of intraday volatility, exactly to your point, right? Part of it, I think, is because of all this headline risk and the flip-flopping, which you guys have talked about. How can investors trade this? So one of the things that we're really seeing is just increased volume in the options market as a way to manage risk in this environment where, whenever a headline comes through, you don't know how long it's going to last, right? The tariff's going to get walked back the next day, the next month. We talked about that. So I think that's why we're seeing just, record volumes, not just in the S&P options, but across the board. And actually record volumes, particularly with zero-day options, as a way to play that intraday volatility in the market.
Now, Mandy, speaking of all the headlines, I think we've all gotten very used to seeing all these crazy headlines. But you're starting to see the markets actually maybe reacting a little less to them, right? Like the first time tariffs were announced, big moves in volatility, big moves in the market. But then as each level of tariffs was announced, markets are starting to kind of, say it's the boy who cried wolf. I'm not sure if they should be worried about that. Is there some sort of correlation with initially when Trump got in office versus now? Are markets moving any less on those headlines?
I would almost say, in my view, at least it feels it's the opposite. I feel like when Trump first got elected, people didn't really know how seriously to take the tariff risk, right? Because they looked at the first term. Look, the first term wasn't so bad. Is Trump 2.0 going to be like 1.0? And one of the things that we've been highlighting is that we think this time is actually going to be a lot different. And I think people are starting to realize that this time tariff is a much bigger risk to markets and a much more serious part of the Trump agenda. And in terms of market reaction, I think the really big reaction is going to come once we see the economic fallout or the economic impact, right? And keep in mind, this is happening at the same time as we're seeing large-scale reductions in the federal workforce. What does that mean in terms of consumer spending? I think that's going to be key to watch.